well, at least makes restarting the negotiations where they were in late April, for sure. Now, I've thought for some time that the logic for China was absolutely compelling, and the data 2 weeks ago, the Chinese-made data, was really pointed in that direction, in as much as whatever strength they had in industrial production or fixed asset investment was in heavy industry sectors, steel, cement. Those are the sectors they know they need to wind down. They have 50% excess capacity in steel. And the consumer sectors like autos, production was falling at a 25% annualized rate. Tech production is weak. So the Chinese logic for reforming their economy, agreeing to stop subsidizing exporters and heavy industry is there. What was evident in this week's data from the U.S. was twofold. Our two single best indicators for productivity growth are labor market turnover and dynamism. And, you get that from the monthly JOLTS report. But before you even get to that, the Conference Board jobs plentiful, jobs hard to get, or labor differential, is a key indicator. Now, it was at a 2-cycle high in May, but it fell sharply in June. Also, the capital spending plan 6 months forward from the regional Fed manufacturing surveys had surprisingly gone up in May, following through from a move higher in March, April, and then into May. But they fell very sharply in June and gave that whole thing back. So it's pretty clear that trade policy uncertainty is a big issue for that capital spending outlook going forward.
Is it going to affect employment, Barry? We started to see jobless claims trend higher. We're, I think, at a 7-week high. Is it going to affect what has been the best part of this economy and what President Trump loves to talk about, the job growth?
Well, that's where I'm going with it. I'm not a big fan of just looking at the monthly payroll number. The last month's number, 75,000 jobs, represents less than 5 basis points of total employment. But every quarter, 25% of the labor market turns over. And when that turnover goes up, as it did in 2014 and it did in 2017 through most of 2018, that drives wages up, but it also drives productivity up. That's a big part of the pickup in labor productivity that was so shocking to the street last year. That if you see a deterioration in that dynamism, people voluntarily quitting, then that would be a big negative for that productivity story and the mix of growth that's kept inflation down. So, yeah, it's tenuous. I mean, there has to be a détente.